the amount of brain power that probably goes into putting a report of that, of that magnitude together, industry-wide, how much of your work would you say is replicated or parallel or incorporated into the BIS framework that is being developed right now?
It's woven so closely with many aspects of regulatory reform that it's difficult to separate the two. You take liquidity management. Weak liquidity management was a factor contributing to this crisis. We published in the spring of 2007 a new set of liquidity guidelines. Unfortunately, our members were only beginning to put them into effect when the crisis hit in the summer of 2007. Most regulators have said, including the chairman of the Basel Committee, that our guidelines provide a approximate roadmap for how to improve liquidity management around the world. So they're taking our guidelines, modifying them somewhat, of course, and now incorporating them into regulatory standards and regulatory philosophy. I'm not saying that they listen to us in every case, but the synergies, the symbiotic relationship between bankers who really want to fix problems and regulators who want to fix problems are actually converging around many areas today. Unfortunately, political pressures could pose a serious risk of driving regulation too far, stifling innovation, and encouraging the kind of fragmentation that could cost serious jobs and wealth in the future.
Given the fact that the banking industry is evolving rapidly and some of the winners yesterday are no longer in play today, some of the banks that have survived the crisis are probably going to be dominant institutions going forward, how influenced are you by your most vociferous member institutions? What is the checks and balances you have in place to ensure that what you develop in terms of best practices is a level playing field?
It's a constant challenge to, of course, ensure that you have the right voices around the table and that you're listening fairly to all the voices. But one of the reasons why we've appointed a vice chairman on regulatory capital from emerging markets, one of the reasons why we created this new group of top emerging market bankers, 25 of the top bankers of the world, is to ensure that we convey and distill a balanced perspective which is simply not trying to serve the short-term interest of our bankers in any one country, particularly an industrial country, but looking out for the long-term interest. We engage as well with the top management of these firms. So we're not captured by the trading floor. We're not captured by the underwriters. They may have a view, but we're appealing to the long-term leadership skills of the banking industry's best talent, and we're appealing to those executives which have survived. The ones who haven't are no longer part of our members.
Do you see the role of the IIF evolving even further to be able to, for example, publish data that that contributes to early warning systems?
I believe there is an opportunity for us to evolve further in that direction. I think it's important that we, as important as best practices are, that we never try to become regulators ourselves. That is the role of the official community. But we have to take greater responsibility to try to detect signs of systemic instability and correct them. It is with that in mind that we created another new group. And it must sound like we're busy just creating new groups, but you have to see opportunities and needs in the system, and then you have to move decisively and opportunistically to address those needs. Market monitoring group. This is a totally separate group from these emerging market bankers. These are market experts, guided by two very distinguished ex-central bankers, Charles Dallara and David Dodge. They've just had their first meeting 3 months ago. What is their goal? Their goal is to harness market expertise from different quarters of the world. We have an investment banker from China. We have a credit officer from New York. We have an underwriting expert from Milan, etc., etc. They are coming together once a quarter with one question in mind. What do we feel? What do we see in the marketplace that poses a systemic risk to stability if it is allowed to continue to grow? And they're beginning to focus themselves on areas of systemic vulnerability. If we'd had this organization in place 3 years ago, there's at least a 20 to 30% chance that we could have all done a better job of anticipating and heading off the crisis. And even if our success rate is only 1 in 10, it'll pay for itself.
Charles Dallara, you've got your work cut out for you. Thank you very much for joining us.
Thank you. It's been a pleasure.